Hi, Joe Lopresti here with the latest Arlington Wealth Management Proactive Strategy Update. Today's Friday, March 24th. Well, in the last 2 weeks since our last update, the market surprisingly has been able to manage a couple of minor up weeks. In the face of a banking crisis, you wouldn't expect that to be the case, but there are a couple of good reasons for that, and we're going to review those reasons in this week's update. And I'll give you a little hint. The Fed's balance sheet is back in growing fashion. They've pumped about $400 billion into the financial system in just the last 2 weeks. In our last update, I think John did, in my opinion, a good job of laying out the 3 different models that we use to make proactive decisions on an ongoing basis: market model, economic model, and market valuation model. Showing you how all 3 play their role in our decision-making process. There is a lot of erratic movement in the markets. If we look at where stocks are today, they're about the same place they were 10 months ago. Whether we look at the MSCI All Country World Index or the S&P 500, certainly have been ups and downs along the ways, but draw a line over the last 10 months and we're virtually unchanged. Of those 3 models, the one that's very clearly pointing in a particular direction is the economic model. That's clearly pointing down. There's no ambiguity about that whatsoever. It's been the case for quite some time. At some point, we expect a recession to develop. The argument could be that the recession takes a while to develop, which gives the market a little bit of runway to move higher before that happens, which, of course, we would expect corporate earnings to be impacted and stock prices to take a leg down at that time. There's always a possibility that the economic model is wrong. That's why we use 3 models. We don't ever want to rely on just one model. It's important to have confirming information and information from a different angle and aspect of the market. Now, we don't think that's the case. In fact, if anything, what we're seeing in the interest rate market as well as the banking crisis probably solidifies the fact that we'll have a recession, and maybe one that is even more severe than what we would have expected just a few weeks ago. When we see the 2-year Treasury note drop from 5% 2 weeks ago to 3.75% today, that's a big drop. And the interest rate market is sensitive to economic activity, and that's picking up a weak economy in the future. And when the country's regional banks are in a liquidity issue, it probably dries up the loan market. They're the biggest lenders to our businesses, medium and small size businesses. They're big lenders to the commercial real estate market. You just have to expect there to be some problems as we go through the rest of this year and into 2024 in those areas. None of that's going to be good for the economy. However, our market model has been positive since the November 30th buy signal, but as John indicated, was teetering on the edge of a potential sell signal if market trends continued to move down. So far they haven't. They've been able to stabilize. And our market valuation model, which had dropped significantly in 2022, has started to turn up. So that's not at its high like it was this time last year, but it certainly isn't at a very low level either. Let's actually start there. I'd like to make a point on the market valuation indicator. So we could see this time last year, this valuation indicator, our proprietary indicator, was at an all-time high, indicating that the future potential for stock prices was very low. And in fact, the indicator's prediction was that in the next 10 years, we'd have negative returns in the S&P 500. Well, we got the big drop last year, and in the fourth quarter, a little bit of a hook up there, as you could see. That takes the pressure off. We're no longer at all-time highs. We're certainly not at low levels, which would predict high future returns. But we're not at the high level either. So we're somewhere in the middle, and that makes this indicator a little bit more middle ground in our decision-making process. Now, certainly the pendulum could be swinging down, right? These moves down from high valuation to low valuation. These are multi-year movements, but they don't happen in a straight shot. And typically along the way, whether it's the 1970s and 80s or the 2000 era, which both saw big compressions of valuation, had these short 2 or 3 year period interruptions in which valuation started to climb again. Those were great opportunities during the longer bear markets of those eras. The 2000 era didn't see as many opportunities, but had one much bigger one that lasted 4 to 5 years. And while these upticks don't look like very much, when we put them in perspective of actual movement in the market indices, like the S&P 500, the S&P 500 doubled in value during this 4 to 5 year period. In 2007, it got back to that high. That was a 5-year period of tremendous growth in the S&P 500, but gave way then to the next wave down during the next recession in 2008. So where we're at now, as you can see, the uptick is in place. And whether this is just a short uptick, we had a couple of short ones here that quickly turned back down. That could happen again. That's why we're watching our market model, which if it goes back negative, we will expect a similar type of result, and we want to move back to wealth preservation if that's the case. But at the same time, if we're starting one of these windows of opportunity within what might be a longer term pendulum swinging down in the valuation, we want to be there to capitalize on that, because it could be one of the few windows in a longer bear market, few windows to make money. So let's take a look at our PAS dashboard. This is really the model that's going to call the shots over the shorter to intermediate term. And what we'd like to do is take a look at some of the specific indicators that drive the model and see what's happened in recent activity to try to gauge if this is a rollover in the market, if we're starting the next leg of the bear market, or if it's nothing to be too concerned about and the uptrend that began a few months ago is still intact. Now, we do see a couple of changes since our last update. For example, the universe trend indicators have turned to neutral status. John reported in our last update the long-term momentum at the end of February had done the same. The cash comparison chart has turned to negative, but I would call that tentatively negative, more of a minor negative, and we'll see why in a minute. Let's start off by looking at the change in the universe trend indicator. So here are both versions of our universe trend indicator, and the one that has flipped down is the traditional scale. And you can see that here. It started in O column. Essentially what's needed to do that, we hit the high in February, as you could see noted by that 2 there. That's when the number hit 52%. Requires a 6% drop in the percent of stocks that have a positive trend. That's what happened. We're now down below 46%. We're at 45 and change. So that's what starts the O column coming down. The logarithmic scale chart really is nowhere close to a reversal. It also hit a high in February at 58%. It's still hanging very close to that level, just a little bit off. So we'd have to actually see a drop down to 52% to start an O column on this chart, so we're not close. Now what's noteworthy here is this indicator is usually a leading indicator. In other words, we tend to see reversal down before a peak in the market, or reversal up before a low in the market, well in advance of that peak or low actually happening. For example, if we just go back to the high in late 2021, early 2022, you can see the logarithmic chart peaked with that 5. That was May of 2021, reversed down in November of 2021 and continued to drop. The market peaked in January of 2022. So we started to see deterioration ahead of that peak. We're not seeing that this time, which to me means that maybe this is more of a reactive correction type of move and not a major reversal down in stock prices. Nothing could be ruled out. This could still be the ultimate high and we could get another leg down. Absolutely, that's very well within the realm of possibility. But typically we see movement in this indicator ahead of market movements. We didn't this time, so there's a chance that this is a setback in a upward trending market. If we move over to our tactical indicators, we could see these are either in the low risk zone or getting pretty close over on the overbought, oversold indicator. So if the model holds a buy signal with these tactical indicators getting to their low risk and oversold levels, it could set up a short-term buying opportunity. So if we take a quick look at the 10-week chart, we could see in February and March it dropped significantly. We've hit the low risk zone. This basically tells us this is a lower risk level to put capital to work than when we're up in this area. An observation on the chart is we've seen kind of a broadening of the pattern with lower lows, higher highs. We'll see if that's able to put an end to that pattern and put a low in at a higher level, which could indicate that upturn potentially taking place, that window of opportunity that I've been referring to on a number of these charts. When we have three models and those models are in conflict with each other in terms of their direction, we have to keep our options open. All options are open at this point. So talking about opportunities develop seems a little odd in the wake of all the bad news we're hearing about financial institutions and government support and everything that we're hearing in the news. If the market is going to rally from this point for some length of time, there's three reasons I could think of that would cause that to happen. Number one, seasonality is still very strong. We're in the midst of the strongest season in the stock market based on election patterns. Following midterm elections, stocks tend to do very well. It's probably one of the reasons why we haven't seen a meltdown during this banking crisis, in fact. The reason is that with midterm elections tends to come gridlock, where there's a balance of power in Washington, and that's exactly what we have. The markets love gridlock. Nothing extreme could get done on either side. The second reason is retail investors, individuals, non-institutional investors, have become extremely negative, have been for the better part of the last year, became just a little bit positive about a month and a half ago, just in time to catch this next leg down in the market, and now those sentiment numbers have gotten very negative. Individual investors, when they act in mass, tend to be wrong. So contrarily speaking, that's a positive for stock prices. And finally, the Fed's balance sheet has begun to blossom again. They've pumped $400 billion into the financial system in just the last 2 weeks. That's unwound 2/3 of all the quantitative tightening that they've done in the last year. Let's take a quick look at each of these potentially positive reasons that stocks could rally from this point forward. Starting off with the midterm election cycle. What you're looking at are the 16 quarters during the president's cycle, the worst to the best. We completed the worst with the third quarter of the second year. That's when the market bottomed. October of last year, the market hit a bottom. So this cycle worked very well on the negative side. We're now in the best 2-quarter period. That's the first quarter of the third year. That's right what we're in right now. But that's followed by the second best 2-quarter period, the second quarter of this year. And not too far away is the third quarter of this year. So until the third quarter of this year, we're in a very strong period that seasonally, historically, we tend to have good stock market action. This goes back over 100 years, so it's not just 1 or 2 time phenomenon. As we get later into the year, the fourth quarter, that strength seasonally starts to fade away. Additionally, when we have those drawdowns in the midterm election year, last year, the S&P dropped about 24% during the year. Well, you could see that happens most midterm election years. Like, for example, 1962, 1970, 1974, 1990. You could go on, even 2018. Those types of drops are typical during midterm election years. 1 year from the low, you tend to see a median 27% move higher. So if that holds this cycle, stocks would be up 27% from last October's low. We're nowhere near that now. We are up from the low, of course, but nowhere near a move to the length of 27%. So that could indicate further upward movement in the coming months before the seasonal period turns negative for stocks. Now let's look at U.S. investor sentiment. This is a poll that's been conducted for years by the American Association of Individual Investors. They poll their members, how many are bullish, how many are bearish, or how many are neutral. The spread between the bulls and bears could be used as a contrary indicator. So we're looking at the last 10 years. You could see that their members became the most negative in the last 10 years and stayed there for quite some time. And there was a little bit of a blip up into February of this year, just in time for the market to hit its high, at least so far for this recovery. And now they've become very negative again. And if we put that into a little more historical context, that low that we saw last year was equal or close to at least the low during the financial crisis in 2008 and another time when there was a banking crisis in the early 1990s. That's the third lowest level ever in 2022. And where we're at now hits levels that tend to correlate with good entry points into the stock market. I mean, think about it. When most investors are negative, they're already out. Mass psychology tends to be wrong. When everyone's negative, the market tends to recover very well and be positive. When everyone's positive, that generally is not a good time. You can see right there, investors generally very positive right before the bear market hit. So with investors positioned negatively, the market may surprise to the upside. And finally, we're seeing a liftoff in the Fed's balance sheet. Now, this is the last 3 years, total assets held by Federal Reserve banks. You could see 3 years ago in the midst of the pandemic, big surge in the Fed's balance sheet. They continued that for probably way too long, a couple of years after the pandemic. They started to wind it down about this time last year, say last April, it hit its high, started to bring their balance sheet down, and look at what happened in just the last 2 weeks. Let's zoom in on that so we could put it into perspective. Essentially, they've pumped about 2/3 of the money back into the system that they've withdrawn, and that took a year for them to withdraw it. So we're seeing liquidity injections. It's much different. They're not buying bonds the way that they were during the pandemic era quantitative easing, but they have opened up different facilities to the banking system. Essentially, that puts capital back into the financial system, and it's one of the reasons why stock prices have been able to maintain value or even uptick a little bit in the midst of this banking crisis. We'll see how far they go here, how much more they pump in, but if they're back to liquidity injections, that could support asset prices, at least temporarily, for a leg up in the stock market. So that's the bullish case. We're not bulls by any measure. We're neutral. We believe that either uptrends or downtrends could happen from here. With our economic model as negative as it's been, it's very possible that stocks quickly roll over. Our market model gives another sell signal. If that happens, we won't hesitate to move back to capital preservation and protection. But we have to be aware that markets can surprise people, and people are negative right now. And there's a lot of bad news, And in a contrary thinking way, it's quite possible that stock prices could rally from here, as we pointed out with some of the information we shared with you today. So we'll continue to obviously watch all of our indicators and models, make the best decisions we can moving forward, and certainly keep you posted as to any significant changes in our models, whether it's in our next update or in between with a flash alert if something important happens. Thanks for watching, and have a great weekend.